IBM reporting mixed results, showing growth in software and AI demand, but softness in other parts of the company. The stock is under pressure this morning following those results. So what does this signal about expectations for the rest of big tech as we hear from companies like Apple, Amazon, Microsoft, and Meta, all set to report next week? Joining us now to discuss, we've got Daniel Morgan. He is the Senior Portfolio Manager over at Synovus Trust. Daniel, great to have you on here. So what is your expectation as we head into those rest of the Mag 7 minus NVIDIA next week?
Well, it's kind of interesting because you reflected on that IBM number, and the IBM number wasn't bad. They obviously missed on revenues, but I think the expectations coming into that third quarter report were extremely elevated. You had the IBM shares trading at over 25 times earnings. Historically, that stock would trade anywhere from 15 to 20 times earnings. So it's really kind of a mixed report because they did say they generated about $3 billion in revenues directly from generative AI. And of course, everyone's really focused on that. So now we roll into next week. Obviously, we have a huge numbers coming out a week from today, Halloween, with Amazon, Apple, and Intel. Those will kind of dictate what's going on. Alphabet is also kind of sandwiched in the middle there. So next week will be a good indication of what's happening in regards to the FANG stocks, the Magnificent Seven, in terms of the tech sector.
How much can we glean from what Tesla reported last night? Does that really dictate, does that tell us anything about what we'll likely hear from the rest of the Mag 7?
Well, I mean, they're in that group, and quite honestly, it sounds kind of strange, but I don't actually follow Tesla because it's not really a technology stock, it's an automaker, but they're kind of clumped into that Magnificent Seven, into those big tech momentum names. And, as your previous guest was saying, it looked like the Tesla numbers should be very good. There's a lot of good momentum coming into in terms of this reporting quarter. So I think that should roll into next week in terms of a positive light in terms of those big tech reports that we mentioned.
Dan, should they be lumped in with those other names?
Personally, I don't think so, but that's my own opinion. I mean, I'm an old line tech guy. I've been in the tech sector since 1990. I remember the Four Horsemen. We didn't add an auto stock in there back with, with Cisco, Intel, Dell, and Microsoft. And then we got the FANG with the N and then FANG with the Microsoft. Again, they're all tech stocks. But then we created the Magnificent Seven because we had to get NVIDIA in there. We didn't have a better way to do it. And we wanted to get Tesla in there. So personally, I don't see how Tesla fits into that group. But to me, they're an automaker. But they seem to be rolled into the tech group.
Yeah, they do seem to be rolled into that, and I guess Elon Musk likes that so long as you believe in the full self-driving car push moving forward. I want to broaden out a little bit because you mentioned in your notes that the macro picture historically has led the tech sector. Does that continue to be true in a world with NVIDIA?
Yeah, definitely so, because, you probably remember, a year and a half ago when the Fed started tightening in terms of interest rates, everybody was worried that we were going to go into a potential recession, right? And then CIOs would cut back on their budgets in regards to the amount of money that they'll spend towards tech. And it's 100% true. I mean, when we see a downturn in the economy, the first thing to go is tech spending. But what we've been able to see is really what we call kind of I call it a no landing. It's not even really a soft landing. I mean, we're going to get GDP here coming out in the next week or so, and it's probably going to be around 3%. We know the non-farm payroll numbers were north of 250,000. So we've had a lot of good positive economic data, despite the fact that the Fed, went through this major tightening cycle. So that all bodes well for tech because everyone's like, well, no impact on budgets. Looks like the CIOs are going to keep spending, and they have. So that's led to strength in the tech sector. So that fear has gone away. And that's one of the reasons why the tech sector has done so well.
But Dan, has it maybe gone away too prematurely, just given the fact that there is still there is still so much uncertainty out there, and there is this real risk that we could see a bit of a scaling back here when it comes to some of that spending?
Yeah, it's true. And if you look at the estimates going into next year in regards to GDP, we're looking for GDP to slow down about 1.5% to 1.8%. So we may see kind of a residual impact from the Fed, a delayed impact, let's say, 6 to 12 months out, where we do start to see slowdowns. And we did see some indication of that on the IBM report, because some of the comments that came out by the CEO was that he felt that, one of the reasons why they fell up short in their consulting segment was the fact that CIOs are using money that would have been designated for consulting, and they're moving that into AI. They're not populating both. So we are seeing little bits of evidence that we may see some slowdown. But guys, I was around in 2000, and I remember when the siphon just turned off after probably around June of 2000, going into that fall, and it was pretty bad. And going into that following spring, I mean, it just ceased to exist in terms of spending. So when the siphon gets turned off, it's pretty bad.